Shalom everyone, I'm Rami Zatzman, your personal economist, and you're watching Playful Economican. Get ready to fucking learn stuff today. Securities. Well, don't know how to start. I need some kind of intro. Many of you have probably heard such phrase like buy low, sell high, or he has a majority shareholding, and many more suggestions that holding shares or stocks is a portable thing to do and might even grant you some powers. Along with that, tons of services have popped up offering common people to buy bonds and targeted at these securities only. The US government issues treasury securities, including bonds, bills and notes, which are hardly regarded all over the world. The Russian government issues federal loan bonds, aka OFZ, which are not regarded seriously even in Russia. I have an entire episode on this phenomenon on my Russian channel. Click the link in the description box below. So, stocks, bonds, securities that you can make money off. But first you need to understand how they work. Buying and selling principles, their similarities and differences, risks, potential returns, everything. Today's episode covers all of that. So, let's go. What is a stock? If you Google it, you'll find out that it's a type of security. Fair enough. And you know how to use Wikipedia yourself. However, the main point is that stocks or shares are securities that can be issued only by legal entities, known as public companies. Stocks entitle the owner to the interest in that company. And by that, I literally mean the right to own a table in that company, a lamp in that company, the right to receive dividends, the right to make decisions, in other words, vote at corporate meetings. Stocks are traded at a stock market, have a value in a respective currency. They can be bought or an exchange or by sign a share purchase agreement. Yep, some people still do that. And now you're probably thinking that you can simply show up at the trading floor and buy stock, then go to the company and get your dividends and the damn lamp. You wish. However, the reality is a little trickier than that. To access the stock market, you have to open an account with a broker. To this end, you need to literally show up at the office and with your passport and fill in all standard documents. You'll be able to deposit cash on your account either instantly or the next day. For small amounts, a mobile app will usually do, or you can simply instruct the trader by phone. Wanna dive deep into trading? You can install one of many available trading terminals. Just Google it. So, you are in front of your smartphone scrolling through the list of stocks, choosing ones that you like. This part is easy, but you can have a really hard time finding out those with the potential to go up with time. See, all stocks went down that day. Could you anticipate that? Probably not, because stocks are high volatile, and that is the biggest risk. This means that they can go down as suddenly as go up again. They are fast to buy and fast to sell. But what strategy should you choose to win when you trade in stocks? You've probably heard before that you should buy stocks or larger players and that'll guarantee your profits. Choose, but no. It's a matter of sheer luck. Say, you can buy stocks of Bank of America at their peak price and then they will gradually but steadily go down. Or otherwise. The optimal strategy by far is to buy stocks or large companies for 3 months. In this case, you don't have to monitor the prices every single day. You buy stocks, Keep them for 3 months, check the prices then and continue with them or review your position. Now to the profit. You need to know the companies you're interested in. Passive trading can yield 20 or 30% annually or can take money away because one should not rush into trading. You should always think your options through and understand the underlying principles. Stocks in general are easy pieces to buy, but choosing profitable stocks in and out. Through with all the said, if you buy blue chip stocks, you're very likely to receive profits by the end of the year. How many stocks can you buy? As many as have cash for or as many as are listed on the exchange. There are only as many stocks as are listed. One does not simply issue new stock. You can find out the exact number of shares traded by going to the NICE website and looking up the company info. And if you then do a basic research of the company website, you'll know the names of its majority shareholders. The laws require such information to the public. Why it is so important? If you see a notice in press that the Secretary of the Treasury bought shares of Woolwich Marketing Corporation, I guess all of us would follow his lead. It's pretty obvious that the price will go up and at least in short term the company is perfectly safe for investing. Because you know, he's the Secretary of the Treasury and his personal finance seem to be well cared of. However, if you heard that Justin Bieber decided to buy a share in the same company, you can easily ignore that, because you know he's obviously not a financial mastermind. It's a clean as day. Now, dividends. They are distributed based on the number of available stocks. But there's the thing. When you buy stocks, your information is entered in a shareholder register. And you'll be notified of shareholder meetings in advance by ordinary mail. I am not kidding. And you can attend the meeting and vote on the agenda, including about dividend description. They literally decide what percentage of the company profits are going to be allocated as dividends. You can go for all 100%, but if you own less than 21% in the company, your vote will be counted, of course. But won't do much. So what's up with 21%? Often a holder of 25 or 21% share in a company, plus or minus, has the power to veto or block majority decisions. Such shareholding allows you to literally come to McDonald's Corporation shareholder meetings and say, no more chicken McNuggets on the menu. Yeah, just like that. And your opinion will overrule the opinion of the majority. And only in a 51% share will give its sole holder the right to make all key decisions in the company and influence the business course significantly. In fact, such shareholder has virtually the ultimate control over the operations of the company without the need to rely on other shareholders. A 51% stake is called a controlling interest. And while this information will surely add up to your general knowledge, it's rather for people with high net worth who will never ever watch my channel. Or if they do, then you know I've been trying to scrape up some cash from a studio for 5 months already. I'm just saying. But let's back to stocks. As you now know, they're traded on a stock market. You need to open an account with a broker. They're easy to buy and sell. It's a quick process. By trading stocks, you can earn 20 to 30% either net or annually if you choose well. Additionally, stockholders may receive dividends once or twice a year. And you don't want to buy stocks blindly. Do your reading on the suggest first. Get some trading. And yes, to enter the market, you can have as little as $500 to $1,000. But if you want to trade through a large reputable broker, you have to have at least 25 grand. Now to bonds. Unlike stocks, bonds can be issued by any legal entity. Bonds represent debt. A company issues bonds to raise funds and pays its bondholders a fixed interest rate for use of their money and undertakes to redeem its bonds and their nominal value at maturity. To put it into perspective, bonds are basically a form of loan. Simply put, by buying corporate bonds you become a company's creditor, and in due time the company will have to pay back the principal with interest. However, bonds are more convenient than applying for a bank loan and much easier than a company is in need of cash quickly. If a company needs money for development, it can go to a stock market. Buying bonds is as easy as buying stocks. Like stocks, they are traded on a stock market through an account opened with the same broker. The process of buying and selling is in principle the same, but we are mostly interested in possible gains. How can you make money with bonds? A bond offers two types of return. The first is its pair. It's a nominal or face value of a bond, and there's an interesting point there. Bonds are often sold at a discount. Let's say you can buy bonds of my company for $90, but they have a face value of $100. This means that at maturity, on behalf of my company, we'll have to pay you $100 for each bond anyway. The second is a coupon payment or coupon rate. This is an interest payment on bonds which I, as a company, pay you as a bondholder for using your money. Coupons can be paid once a year or once a quarter or even once a month. An average coupon rate for US government bonds is about 2 to 3% annually. For Russian bonds, it's 9 to 12%. It is, in effect, a fixed interest rate, or the amount you paid for your bonds. Seems easy, right? But sometimes bonds are certain companies can trade at a higher price than its face value. Let's say that a bond has a face value of $100 but is traded at $110. Why someone would want to buy such securities? It appears that coupons on such bonds are usually higher than average, let's say 10% annually. The total return on such bonds will be high as well. Therefore, such bonds are appealing to investors. Stocks and bonds are different not only in the way they produce returns, they also have the different levels of volatility. Unlike stocks, bonds are not likely to dramatically depreciate, and they rarely gain much value as well. With what's said, both types of securities still have risk in common. First, it's an issuing company itself. If the company is the price of shit, its securities are likely to be shitty as well. Don't go blindly after super-duper high returns. Think twice why the company is offering such a return. It's highly likely that it has some issues. Another risk common for both stocks and bonds is the broker risk. As investor, buy securities through brokers. What if your broker's license is revoked? First and foremost, don't worry. Panic instead, hastily, because it's the end of the world for all of us. In fact, your securities are safe. They didn't disappear in the thin air because they are kept in a depository, not at your broker's. And all you need to do is to find another broker, apply for transfer of your securities to their depository, and continue receiving income on your securities. Anyways, apart from making money by keeping your stocks and bonds, you can also buy, sell, exchange, give as a gift for transfer your securities to another person on any provisions that you are okay with. Let's sum it up. Bonds are good for investors who want to invest in a stock market and receive steady income above bank deposit rates, but who are not willing to be actively involved in trading. Stocks, on the other hand, require your close attention and your immediate response to changes in the market environment. In general, you cannot clearly answer a question of whether one type of securities is more profitable than the other. It all depends on what you want from your investment. Whether you want to invest your money and forget about it for a while, or you are ready to monitor quotations daily and trade as hell if needed. There is many nuances, similarities and differences. I hope I succeeded in making all that clear to you, and armed with this knowledge, you'll be able to take an informed decision on what is better for you personally at the moment. And apart from stocks and bonds, there are plenty of other complete investment instruments which can be used to invest your savings with minimum risks and reliable returns. You will learn about this and a lot more on my channel. Remember to subscribe so that you never miss out of anything important. Thanks for watching and live a wealthy life. Rami.